Welcome to The Explainer. Today, we are sinking our teeth into QMM Dental Group's full-year financials for 2025. Now, from an investor's point of view, the numbers tell a really interesting and maybe even a little confusing story. So let's jump right in. So, here's what's on the docket. We'll kick things off with those big headline numbers. Then we'll get into what's actually powering the business. We'll look at their financial health, what their game plan is for the future, and then we'll wrap it all up.
Okay, let's dive right in with the headline figures, because right off the bat you see something that looks like a contradiction. It's like we're being told two completely different stories about how the company is doing.
Yeah, look at this. On one side, the total profit that goes to shareholders, what they call PATMI, it's down a pretty hefty 35%. Ouch. But then you look at the other side, and the profit from their main dental business, that's up a very, very healthy 16%. So what in the world is going on here? That's the big question, right? How can the main business be thriving while the overall bottom line is taking such a hit? Let's unpack it.
To really get what's happening, we've got to start with the good news. Let's look at the performance of the company's main gig. The engine that powers this whole thing.
That 16% increase, that is the number you really need to focus on. It tells you that deep down, the day-to-day business of being a dental group is doing really, really well.
And this isn't just a one-off. The fundamentals of the company are just solid. You can see it right here. Both the core profit and the core revenue took a really nice jump. This is what a healthy, growing business looks like at its heart.
So, if the core business is firing on all cylinders, what on earth happened to that overall profit number? Let's play detective and solve this little puzzle, because there are very specific reasons for the difference. Okay, the biggest culprit is something called subsidiary consolidation. Now I know, that sounds super technical and boring, but stick with me. The easiest way to think about it is with pizza. Before, Q&M owned just a slice of a few other companies, so they only reported their slice of the profit. Now they own the whole pizza. That means you get all the revenue, which is great, but you also have to account for all the costs, and that can make the final number look a little messy.
So the bottom line is that profit drop wasn't because they were doing a bad job. Not at all. It was a combo of very specific things. That accounting change we just talked about, higher interest payments on some funding they took on, stock plan expenses for their staff, and a few other one-time bookkeeping things. These are basically the costs of getting ready for future growth, not a sign that the business is weak. All right, let's switch gears and look at the company's financial foundation. A quick peek at their balance sheet shows a company that isn't pulling back. Nope, it's fueling up for a big move. Check out this number, $117.1 million. That's the cash they had on hand at the end of 2025. That is a huge jump from about $34 million the year before. So you might be asking, where did all that cash come from? Well, here's the other side of the coin. At the same time, their total borrowings also went up a lot, all the way to over $143 million. And as you can see, this was no accident. This was a very deliberate move. They basically went out and took on more debt, specifically to build a massive cash war chest. Now, this isn't a sign of distress, it's a sign of ambition. They're gearing up for something big. So what's the plan for all that money? Well, they're not just going to let it sit in the bank. The company has been crystal clear, laying out a specific blueprint for some really aggressive growth across the region. You don't have to take my word for it. This quote from the company's own press release says it all, doesn't it? They built up that cash pile with one thing in mind, hitting the accelerator on their expansion plans. And their strategy is actually pretty clever. They're not just going on a shopping spree and buying clinics. No, they're creating partnerships. They use a mix of cash and their own company stock in these deals. What this does is turn the old owners into new partners who have a real stake in making the whole group successful. Pretty smart.
A really key part of this whole regional strategy is focusing on China. They're planning to use their subsidiary there, Oxen Q&M, which is already on the ground and knows the local rules, to really lead the charge on that expansion.
Okay, we've covered a ton of ground here, so let's just quickly pull it all together and recap the key things you need to take away from Q&M's 2025 results. So here's the bottom line. Don't let that scary headline profit number fool you. The actual underlying business is strong, and it's growing. What's really happening is the company has made a very deliberate, very strategic decision to use debt to bankroll an ambitious expansion across the region. And that leaves us with a big question for any investor, right? The strategy is clear, they've got the cash, and they've already started. But the question is, will this bold, debt-fueled expansion plan actually pay off and create real long-term value for shareholders?
That's what we'll all be watching. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.